Hi everybody, my name is Jeff Fowler. I'm with the Apartment Owners Association. It's great to have you with us today. And today we're going to learn more about 1031 exchanges. And this is just a tremendous way to avoid capital gains tax, so definitely listen in. AOA is one of the largest individually organized groups of apartment owners here in the state, and we have a lot of different services to equip you and put the tools in your hands so that you can successfully manage your properties and hopefully do it with greater ease and more effectiveness. So that's what we're here for. And we do have a brokerage. If you didn't know, it existed before AOA was born even. And if you're in the LA area, definitely think of our brokerage if you're thinking of selling. And in addition to that, there's always forms that we're updating, and so there's more and more things up there all the time. And I know that a lot of you are members because of the forums, and so thank you for being a member, and I'm glad that we're able to help you with that. If you want closed captions, you can go to Facebook and watch us there. So, and then also just some things you may have missed. 2 weeks ago, we had Zorn Windrich talk about how you could he could look at a property and potentially find extra units there for you without having to build an ADU, just taking maybe a 10-unit building and being able to take a couple units and split that and make more units there. And so that was a powerful talk and a great way to increase your revenue. Also, we had our speaker last week share about how you deal with a criminal hit when you are looking at a rental application and you see the credit report, the background check, and there's criminal history there. How do you deal with that without getting in trouble? And so that was also last week. And I'm looking forward. And then today also we had a group that they inspect decks and just make sure that you're compliant. Man, I'm kind of losing it here. Here we go in the afternoon. And so anyway, that was another good one to help you make sure that you're compliant with AB 721 and also another one. And so that's a state law. That was a good question that was asked. It's not just LA or it's not just Oakland, but all over the state. Your balcony and your decks, if they're wood, they need to be inspected every 6 years. So definitely you want to listen to hear more about that. All right, and then we're going to be in Oakland in person and on June 23rd. Really looking forward to that. And then also back in Oakland and in Santa Clara in July. So those are a couple things that are coming up that are in person. We had a great time in San Diego a few weeks back. And anyway, so here we go. We finally get to it here. This event is sponsored by Real Estate Transitions, and they are going to help you transition. If you're in the fourth quarter and you're ready to come out of the active management, make things more passive, these guys are great for you. They're a real estate investment advisory firm. They have 3 offices on the West Coast. They do about $220 million annually in replacement properties, and they're licensed in all 50 states. Our speaker today is in operations, marketing, education, and he wears a lot of different hats within the company. And he grew up in the industry, and his dad founded the company. And he was a CPA at PwC. It's my pleasure to introduce to you today Austin Bowlin.
Jeff, I appreciate the introduction there, and it's a pleasure to be sharing with you all today. As mentioned, my name is Austin Bowlin. I'm a partner at Real Estate Transition Solutions, and today we will be sharing about the process of identifying 1031 exchange replacement property. We've got quite a bit of content ahead of us. I'm going to be moving fairly quickly through this. One of the replacement property options that we'll be discussing about in brief is the Delaware Statutory Trust. Delaware Statutory Trusts both qualify for 1031 exchange purposes, but are also registered securities with the Securities and Exchange Commission. And as such, there is a requirement that in order to invest in DST replacement property, one must be what's considered an accredited investor. Typically, that means having a net worth in excess of $1 million, not including the value of your primary residence. But alternatively, you can be considered an accredited investor by having net worth in excess having annual income in excess of $200,000 if single, or $300,000 if married filing jointly, or by holding a number of professional licenses or certifications, such as securities licenses or a CFA charter. A little bit of background on our firm, Real Estate Transition Solutions. We are a real estate advisory firm that services property owners that are transitioning from what we consider to be the third to the fourth quarter of property ownership. This is a period of time in where owners are often looking to take a step back from the duties associated with day-to-day management or overseeing third-party property management, looking at the real estate in which they own and understanding that if they were to outright sell properties, they would face significant tax consequences, especially for individuals residing in California or owning property in California. I'm also wanting to place a greater emphasis moving forward on stability, predictability, generating stable income, diversification among various property types, geographic areas, and an increasing emphasis on estate planning as well, to stage for that eventual step up in basis that can eliminate the tax liability that's been accumulated and deferred over decades of ownership, and then also a seamless transition to beneficiaries. The firm was founded about 20 years ago by my father, Roger Bowlin. He began his career in traditional commercial real estate brokerage, followed by about 2.5 decades in wealth management. It was during that period of time in which he really designed and built out the framework that we utilize for understanding and identifying owners' objectives, both financial and lifestyle, and applying that to the context of investment real estate. I joined the firm about 6.5 years ago at this point. I'm a CPA by background, and previous to working with Real Estate Transition Solutions, was at a large public accounting firm, PricewaterhouseCoopers, first in their audit practice, followed by their mergers and acquisitions advisory group. Our team's structured in a way where we have a team of exchange advisors that work directly with property owners. We have a full in-house due diligence team that is constantly underwriting and analyzing replacement property options. Also, investor relations and operations, and then our marketing and education team that develops much of the content in which you've likely seen shared through AOA and available on our website. What you'll see here is an overview of what we'll be discussing. We're going to do a quick refresh on the 1031 exchange, followed by discussion of the overall exchange process. And this exchange process and timeline is looking at it from more of a 20,000 foot view to really go through the steps needed to develop a comprehensive exchange strategy. We'll then talk about the various ownership structures that qualify for 1031 exchange purposes. We'll touch on some of the property types and key differences among those property types. We'll refer to some of the trends that we're currently seeing play out throughout investment real estate on a national level, and then share some other additional educational resources that we have available to you all, and then open it up for some Q&A. So as a reminder on 1031 exchanges, Section 1031 is a component of the tax code that allows for a owner of investment real estate to sell their property, and provided they adhere to the rules and requirements associated with 1031 exchanges, they can defer all of the tax that would otherwise be due upon that sale. And when I refer to that tax that would be due upon a sale, that's going to be inclusive of not only capital gains tax at the federal level, but also depreciation recapture tax, which is at the federal level a flat rate of 25%, state income tax, which can be as high as 13.3% in California, as well as the often overlooked net investment income tax of 3.8%. So all of that tax that would be due upon the sale of an appreciated property can be deferred into replacement property. And when looking at 1031 exchanges, you'll hear a term regularly used, which is the property must be like kind. The replacement property must be like kind to the replacement property. So when you hear like kind, it's easy to assume that that definition is fairly narrow. Property type to property type, say apartment buildings to apartment buildings or industrial to industrial. But what the IRS is actually referring to within like kind is not so much the type of property, but the intent as to why that property is owned. And within the intent realm, there's really only two categories. There's property that's held for personal use. So that would include your primary residence or a second home, like a vacation home. And then there's property that's held for business or investment purposes. And all property held for business or investment purposes is like kind with one another. What that allows for is for you to, say, sell an apartment building or single family rental or duplex and actually take those proceeds and exchange into industrial or self-storage or retail or hospitality or, of course, multifamily or single family as well. Very commonly, as an owner is making that third to fourth quarter transition, they're looking to move a asset base or portfolio or of real estate that is concentrated in one particular property type into an environment that's going to be more diversified, given that different property types will behave in their own ways throughout market cycles. Now, the 1031 exchange timeline or process consists of the 9 steps that you'll see on both this slide and the following slide. And when developing an exchange strategy, it's important to walk through each of these steps so that where you end up after the exchange is actually where you intend to go. First step is going to be to understand the tax liability that would be due upon the sale. And we have a number of resources available on our website that would allow you to calculate an estimated tax liability, or we're happy to have a conversation with you to run through those numbers and provide an estimated liability for you. If the tax liability is sufficiently large to warrant performing the 1031 exchange, then we move into the education phase, making sure that you know the rules, the mechanics, the timeline associated with the exchange. Legal entity on title, debt replacement requirements, 45-day identification timeline, identification approaches that can be utilized, and so on and so forth. What we're going to focus on today is steps 3 and 4, setting objectives, both financial and lifestyle, and then evaluating replacement property options. Why that's important is because the objectives are really going to be what determines the framework through which you evaluate replacement property options. Should you change property types? Should you look at a different ownership structure? What sort of timeline do you want the property to be held for? Are you motivated by primarily income or appreciation or a combination of the two? Is liquidity a consideration that needs to be taken into account? Many property owners find themselves in a situation that is often referred to as property rich, but cash poor. And so in that environment, as one ages, it is important to have available liquidity to address those unforeseen expenses, especially as one ages and enter more expensive years. So knowing your objectives, going through the process of determining those objectives, and looking at your exchange, not as an isolated transaction, but instead in the greater context of where you are trying to go over the next 1, 5, 10, 15, 20 years is very, very important to have an effective exchange strategy. Once those objectives have been determined, then replacement property options need to be evaluated within the context of those objectives. Property types will behave differently. Ownership structures allow for different strategies to be utilized. Liquidity can be addressed that way. Passive ownership can be addressed that way. Active management can be addressed if that's a goal of yours. So analyzing properties reflective of those objectives is the important next step. Once the exchange strategy has been developed, now you work through the typical sale process for your investment real estate. Usually this includes engaging a broker to value and then list and market that property, qualify buyers, field offers, go under contract, and then ultimately close on the sale of that property. That process is the same regardless of whether or not you are planning to perform a 1031 exchange or not. With the one exception being once your property is under contract to sell, meaning you have a signed purchase and sale agreement, at that point, you're going to want to open up an exchange with an entity that's referred to as a qualified intermediary. That qualified intermediary will serve as effectively exchange escrow, meaning that upon the close of the sale, funds will move from the buyer to escrow, and then instead of from escrow to the seller, they'll move from escrow to the qualified intermediary, where they'll be held on behalf of the exchanger as they are identifying and then ultimately acquiring replacement property. When you're working through the actual exchange itself, you have 45 days to identify your replacement property, and then a subsequent 135 days to actually complete those investments. Following the exchange, it's very important that your tax preparer has all of the necessary information from the exchange, the sale information and closing statement, the replacement property's closing statement, understanding of the exchange strategy and what was implemented in order to appropriately and accurately report that exchange at the end of the year so that you can receive the benefit of that tax deferral. Now, when we talk about owners' objectives and building that framework for evaluating replacement properties, we see a number of key themes that present themselves when looking at an owner who's looking to take a step back from management and transition into that, from that third to that fourth quarter. When we are dialoguing with property owners, we're often asking them questions about whether or not they want to be actively involved in their ownership, whether or not they want to continue to make exchange decisions down the road, whether liquidity is something that needs to be taken into account, what the overall estate plan is. Are they looking to predominantly spend the net worth that they've worked hard to build over the decades before they pass away? Or do they want to leave a nest egg for a surviving spouse or for beneficiaries such as children or grandchildren, nieces, nephews, not-for-profits, whomever that may be? How much of the income that they're deriving from their replacement property is taxable versus sheltered by depreciation? Are they looking to enhance the amount of depreciation that they receive from their investment property? Leveraging what is one of the primary tax benefits associated with investment real estate, that ability to shelter income and have it not be subject not only to federal income tax, but also state income tax. Is diversification a goal? Are they trying to reduce or lower their overall risk profile or escape the oppressive regulatory environment which we all operate in today? And once those objectives have been established, then using that to evaluate replacement property options, looking at the ownership structure, the age, vintage, investment thesis associated with that property, whether there needs to be debt on the replacement property, how much tax sheltering could we expect to realize, what would be the return profile associated with that property, and then what is the risk profile associated with that property as well. There are three primary ownership structures that qualify for 1031 exchanges. The first of which is the ownership structure I referenced at the beginning of the presentation, which is the Delaware Statutory Trust. Second is the tenant in common, another form of fractional ownership. And then third, perhaps the widest tent or the largest tent is going to be fee simple ownership. And there are a myriad of investment strategies available within fee simple ownership. The Delaware Statutory Trust is a form of ownership that allows for an accredited investor to exchange into owning a percentage of larger institutional quality properties. When I use the term institutional quality properties, we're referring to properties of the size and scale that you typically see being acquired by the likes of a life insurance company or a real estate investment trust, a REIT, or a university endowment or pension plan. Generally, these are single assets that would range in value between, say, $60 to $200 million in value. Or if we're talking about smaller properties such as net lease retail or self-storage or medical office, commonly we'll see a portfolio of these properties packaged together in a single Delaware statutory trust. What the DST allows for is an individual to, for illustrative purposes, say sell a property for $2 million and then take a portion of those proceeds, maybe it's $500,000, and exchange into owning a 1% interest of a multifamily property in Dallas, Texas, and then take another $500,000 and acquire a percentage of a Amazon fulfillment center, and another $500,000 into a portfolio of self-storage, and the remaining funds into, say, a portfolio of medical office or a hospitality property. Property types that one may not feel comfortable acquiring on their own and certainly don't have the purchasing power to acquire those properties in their entirety. But through the Delaware Statutory Trust structure, they can acquire a percentage of that property, which will then be managed on behalf of the investors, income producing for the investors over the life of the DST. And then eventually, when that property is sold, which on average tends to be about 5 to 7 years down the road, then return the sales proceeds to the investors, including any potential appreciation, so that they can perform a subsequent 1031 exchange and continue to defer their tax liability. There are a number of reasons why one may consider exchanging into Delaware statutory trusts. We have a number of educational pieces on our website available, and also webinars that are presented through AOA, and we have recordings of as well. So if you're interested in learning more about this replacement property category, I encourage you to engage with that information. The tenant in common is another form of co-ownership that shares many similarities with the Delaware Statutory Trust, but also some key distinctions. Perhaps the largest is that the tenant in common does not have the parameters around it that the Delaware Statutory Trust does in terms of what can be done with that property over the life of the investment. So if someone's looking for ground up construction or something more opportunistic like extensive value add or acquiring broken retail or re-tenanting commercial office, that's going to need to fall within the tenant in common structure if they're looking for those investment strategies with fractional ownership. As a result of that, we typically see the investment minimum be higher with tenant in common properties, whereas the Delaware Statutory Trust will commonly have a $100,000 minimum equity investment. The tenant in common often has $1 million minimum investment requirement. And as I mentioned, fee simple ownership is perhaps the widest tent, in which you'll see strategies such as acquiring your own property that you manage yourself to do a heavy value add strategy, or run as a vacation rental, or have classified as investment property for a period of time, say 2 years, so it qualifies for 1031 exchange purposes, but then repurpose that property to personal use. So it could be a vacation home, or could even eventually be your primary residence. There are an endless number of strategies available within the fee simple realm. The one key theme as relates to the owner profile that we really focus on serving is that typically these strategies require more active involvement by the owner of the property. As I mentioned, various property types are going to behave differently throughout market cycles. For example, when we look at an inflationary market, such as that which we're in today, all real estate realizes some benefit from that because replacement costs, the cost to build a competing property from a material standpoint, from a labor standpoint, increases, which is one of the primary methods that investment real estate is valued, replacement cost analysis. That being said, there are certain property types, like multifamily, self-storage, hospitality, that given the short duration of their leases, actually have the ability to capture inflation on an ongoing basis. Whereas industrial, medical office, net lease retail, those properties have long-term contractually obligated leases that are defined as to what the rent escalators are going to be year over year. It's not to say that one is necessarily better than the other, but they'll behave differently in an inflationary market. If you were to look at another scenario, say one were to enter into a recession, then you have quite a bit of stability in those corporate guarantees on the net lease properties. Whereas you can have a little bit more volatility, if you will, on those short duration lease properties. There are also investment strategies that can be utilized in some property types, but are not as applicable to the other. Intent of this slide being that it's important to understand those dynamics associated with the various property types and look at it within the context of what your objectives are, and understanding that through some of the ownership structures that we've discussed today, you can have access to all these property types and piece them together in a blended portfolio with an allocation that reflects your objectives. There are a handful of key themes that we've seen playing out throughout 2021 and trends that we expect to continue to develop over the course of the year. We've seen quite a bit of relocation this year as there's been an increase in migration from dense urban environments to more suburban and mid-sized cities. Much of that demand for the relocation was generated in the previous 2 years, and the opportunity to move actually opened up this year. We're continuing to see increasing demand for industrial property as supply chains become more decentralized, in large part lessons learned as a result of COVID. Office space continues to have growth in the suburban markets, but remains somewhat of an unknown in the denser urban environments. And it'll be very revealing as these leases begin to expire to see what sort of renewal activity is occurring with the larger commercial office tenants. Of course, it's an inflationary market, and demand for multifamily continues to be high, especially as home ownership costs have just skyrocketed over the last year and a half, 2.5 years. And then the backlog of travel is really surfacing in the summer of 2022. So we're seeing significant demand for hospitality. Fuel prices have done little to actually disrupt the amount of travel that's been occurring. And for anyone who's flown in the last 2 months, they've seen that on the ground at the airports of just how much traffic there is in those major thoroughfares. The reason why one would consider working with an exchange advisor is so you can have an advisor who's experienced in engaging and dialoguing about these objectives and draw on their experience having worked with hundreds of exchangers in the past to then ultimately design a strategy and provide recommendations that are going to be reflective of your objectives. Now, of course, I understand and appreciate that some property owners are very independent individuals, and you can always go about and do it on your own as well. There are a number of resources available online through services like Zillow, Redfin, LoopNet, et cetera, where you can find properties and then ultimately acquire those on your own. But the exchange advisor will come along to understand and dialogue about those objectives, develop the exchange strategy, walk alongside you through the execution of that strategy to make sure that you have a fully tax-deferred exchange, if that's the goal, as well as replacement properties that are consistent with your objectives. And all of your other advisors are familiar with what occurred, your CPA, your financial advisor, your estate planning attorney, and the like. If you're interested in seeing replacement property options that we work extensively with, specifically within the Delaware statutory trust structure, our website has what we refer to as a marketplace available where you can see properties that have made it through our due diligence process. This is not so much a menu to choose properties from, but instead will give you a feel for the size and caliber of the sponsors we work with and the quality of the properties that are typically being presented in this ownership structure. And if you have any specific questions about your situation or are interested in having a conversation with an exchange advisor, we are always happy to extend that opportunity to AOA members. Best way to do so is by reaching out either at the number you see over email or visiting our website, re-transition.com/AOA, in which you'll see a number of educational resources addressing specifically California multifamily and residential property owners. But we are always happy to have a 15, 30, 45-minute conversation to learn more about what you're seeking to accomplish and what options are available to you. On our website, we also have 2 guides that are both very helpful resources, and webinars are a near weekly occurrence. So if this is a good medium for you to learn information about investment property, 1031 exchanges, and replacement property options, I encourage you to engage with that content. And lastly, as a quick refresh, that website that I mentioned, specific for AOA property owners, is re-transition.com/AOA. That's all I have. Jeff, I'm going to hand it back over to you if we'd like to open it up for some Q&A time.
Great. Thank you so much, Austin. And so I'll just recap some people. If you came in late, we do have a few things going on. Last week, we had someone share about how to handle a criminal report when you're running a background check and you happen to come across one. That's just good to know what to do. I know there have been questions about that, so we wanted to address that one. And the week before that, Zorn Windrich came and he helped to set up the LA County systematic code enforcement. And that was, so he just is a real, like a national treasure, or at least a Californian treasure for sure. And he's got a great eye to look at a property and to see how you could make more units out of that without it even being an ADU. So that was pretty cool. And just a lot of good wisdom there, and especially just the real obvious one, but just make sure you get a permit whenever you're going to do something, because everything's good until it's not with that. And so those were some things in the past that you may have missed, and then in the future. And oh yeah, by the way, if you have a question, definitely write it in. And there's a blue help button at the bottom of the page on the AOAUSA.com website. So you can type in your question there. And then of course in the chat, you can put your question up. The only bad question is the one not asked. So go ahead and write those in, and Austin will take those. And we're going to be in Oakland in a couple of weeks on the 23rd, and that'll be how to screen a tenant legally. And that'll be, so that'll be a good one. And then the month after that, we'll be in Oakland and also in Santa Clara. So for those in-person seminars, really pay attention to whether it's in person or whether it is something that's online as we start to kind of get things going. And anyway, so with that said, thank you so much. One question is, what's the lead time if when do they need to contact you if they're thinking of selling their property? And, what kind of lead time do they need to be able to do a 1031 exchange into a DST with you guys?
It's a great question. So the more lead time, the better, at least to front load the education process and begin learning about one's objectives and whether DST replacement property is consistent with those objectives or not. At a very minimum, if you are planning on doing a 1031 exchange, it's imperative that exchange be set up before the close of the sale. you cannot retroactively go back and decide to do a 1031 exchange. So if you've already sold on your property, if you've already sold your property and you did not elect to open up a 1031 exchange, unfortunately, that ship has sailed at that point. When looking at the Delaware statutory trusts, we can work with someone with as little as, say, 2 to 3 days left in their identification period. That's far from ideal, but that's the case. But there's quite a few, dozens of times where we've been able to preserve an exchange and did not communicate with an owner until all the way at that point. What I would encourage is, even if a Delaware statutory trust is not necessarily your primary replacement property option, you reach out, we begin the process of familiarizing you with those properties, begin sharing properties with you, so that there's not going to be this crunch at day 35, day 40, day 45. So the sooner the better, but we can work on a fairly tight time frame when completing an exchange.
Okay, great. Here's Nori. Thank you for your question. I've been hearing from other realtors and lenders about President Biden will get rid of the 1031 tax exchange. If so, what will replace that?
This is a question we've been fielding regularly over the last 2 years. And what it really began with was a campaign promise, if you will, in the 2020 election, saying that if elected, President Biden was going to outright eliminate 1031 exchanges. Once he was elected, I think reality set in as to what that would entail in terms of pushing that legislation through Congress, which it would require an act of Congress. We're talking about tax reform in this situation. And then, frankly, fighting the real estate lobby on that, who is very intent and very successful at preserving 1031 exchanges. Couple items to note. One, Section 1031 has been in the tax code for over 100 years at this point. So there is some longevity and resilience associated with that piece of the tax code. Two, modifying or eliminating 1031 exchanges is talked about all the time. So I wouldn't be overly concerned about it being part of the conversation right now. And then three, when those realities set in and President Biden took office, then we quickly saw the proposal get watered down to maybe limiting 1031 exchanges to a certain amount of gain, or perhaps only allowing those that have a certain level of income or below to qualify for exchanges. None of those options are palatable by the real estate lobby. And there's research that shows, produced in large part by Ernst & Young, EY, which is one of the big four accounting firms, just what the economic impact of modifying or eliminating exchanges would be on our GDP. And it's significant, given that about 15% of our GDP is tied to the construction and real estate sector in some capacity. The impact is not purely on developers or property owners who may be fairly financially sound. It's also front desk employees and wage earners and lenders and appraisers and the like, everyone who works in that ecosystem. So at this point, coming into midterm elections, and this is a topic we track closely, as you would expect, we think there's very little chance that there will be any reform done to Section 1031. But I can almost assure you, regardless of who sits in the Oval Office or what the balance in Congress looks like, it will be talked about again. And we will go through the same drill again, and likely with the same end result.
All right, great. And what's the percentage? How does it work out? Like when someone sells their property, what percentage what cut do you guys get?
So the work that we do for due diligence on the DST sponsors, due diligence of every individual property, and then working with the owner to go through that process of determining and evaluating objectives, designing the exchange strategy, and then walking through the exchange. Our compensation that we receive for that is directly analogous to buyer's representation, as if one were to go out and acquire another piece of property, whether that's a residential property or a commercial property. we can receive a commission for representing the investor paid by the seller of the property. And that commission is consistent with what you would see in traditional commercial real estate brokerage.
Okay, great. And the question here, are you able to get out of a 1031 exchange? If let's say they go into a DST and they want to pull their money out before it's time for that institutional property to be sold.
So you can always get out of a 1031 exchange, the transaction itself. So just say you sell a property, you open an exchange, funds move to the qualified intermediary, and you decide, you know what, I don't think I want to do this. I'm going to pay tax instead. At that point, you can close down the exchange. Your sales proceeds will be returned to you, and you would find yourself in the exact same situation as if you had not started a 1031 exchange. If you invest in a Delaware statutory trust property, it's important to view that property and understand that it is an inherently illiquid investment throughout the life of the DST. That DST property is held on average for 5 to 7 years. Some will be a little bit shorter, some will be a little bit longer, with typically a maximum hold period of 10 years, although very rarely do we see property held that long. That doesn't really allow an opportunity for one to say, I want to exchange out of this property before the property itself is sold and invest in something else. If the intent would be to have liquidity, there are Delaware statutory trusts that instead of being held for that 5 to 7 year period, are typically held for 2 to 3 years and then absorbed into that sponsor's REIT. This is a transaction structure that's referred to as a 721 UPREIT. And we did a presentation with AOA that focused purely on this transaction structure. It can be a great strategy for those whom it's applicable for. But one of the benefits of now owning REIT shares as opposed to the DST is that you do have control over when you decide to sell those shares. Now, mind you, opting to sell shares would be a taxable event. You cannot exchange out of those REITs, but you could choose to sell $50,000 or $250,000 of shares per year or in specific years based off your own circumstances. So that liquidity and flexibility can be a good fit for certain profiles.
Great. And last question here, unless someone writes a question while you're answering, what percentage of the 1031 exchanges are actually 1031 DSTs?
The percentage of 1031 exchanges as a whole?
Yeah.
A fairly small percentage, given that Section 1031 is used by large institutional real estate groups, used by pension plans, life insurance companies, REITs on a regular basis. So, if I were to throw a number in the air as to what percent based off of total property value acquired is utilizing a traditional 1031 exchange into a fee simple property versus exchanging into a DST property, I would say it's probably sub 2 or 3%. In 2021, we saw about $15 billion of DST real estate acquired. That number will likely be slightly higher this year than it was last year. But that is a drop in the bucket when compared to all institutional real estate and all transaction volume across all property tiers. Great.
Well, Austin, thank you so much. Doesn't look like we have any more questions for right now. And are you going to be coming to the AOA trade show?
Oh, I don't know. I'll have to check with our team to see when that is and if it's on the calendar, but I'd certainly love to.
I think you guys are. You probably just aren't, you may not be aware of it yet. But yes,
that may very well be the case.
At the Long Beach Convention Center. Hopefully we'll finally be able to meet each other face to face.
I love that opportunity.
Yeah, absolutely. And hopefully we'll see the rest of you there October 27th at the Long Beach Convention Center. And man, it's going to be awesome. All the speakers that we have lined up, you'll learn a ton, get lots of ideas. And anyway, so that'll be cool. And anyway, I'll probably see you next month.
All right. You know it, Jeff. I'm already looking forward to it.
Okay, Austin. Take care. Everyone else, we'll see you later. Thank you.
Have a great afternoon. Bye-bye.